Good morning, good afternoon, good evening, tax superstars, depending on where you are located. And welcome to our 2022-2023 Global Indirect Taxes Update series with 5 exciting topics all the way through June 2023. Today, we will host the second of those 5 interactive event sessions, and we're not alone. I'm happy to share with you that many people from all over the world have registered for today's event. This series of events will help you and your organization navigate the significant changes that have been made to indirect taxes globally and provide an overview of technical and commercial considerations across all key jurisdictions. The webinars will also cover e-commerce, indirect taxation in a sustainable economy, and customs duties. Please take a few minutes to read through the disclaimer for this event. We truly look forward to all of your questions and comments. You can do so by using the Q&A box on your toolbar at the bottom of your screen. Even if you cannot see the questions, the host can see them. Due to time restrictions, our presenters will do their best to respond to all questions received during the event. We will also conduct a short survey at the end of the event, which will be anonymous. We would appreciate your honest feedback, as this enables us to improve our virtual event offering to you. The survey will automatically pop up on your screen after the session ended and will take less than 2 minutes to complete. By way of introduction, my name is Stefan de Keulaar. I'm PKF International's Head of Tax based in Belgium, and I'm joined again throughout the series by Luigi Longarella, who leads PKF International's Indirect Tax Pillar and who is a member of the International Tax Committee. Without any further ado, I will give the stage to our first presenter, Luigi Longarella.
Grazie. Grazie, Stefan, and thank you for having me here once again. And it's great to get the chance to narrate some truly groundbreaking events, and to do so less than a week after the European Union Commission has shown its cards relating to its VAT in the digital age review. At long last, and after a couple of postponements, and after also over a year of speculation on the matter. So this is the only topic that we're going to be covering today: EU VAT in the digital age, and if implemented, which I guess is pretty much of a given despite the lengthy processes ahead of us, it will be the biggest change to the EU's VAT system since the establishment of the single market at the start of 1993. And that was only 6 days ago, but we're still buzzing. And that is because on the 8th of December, so just under a week ago, the EU Commission proposed wide-ranging draft legislation amending the core of EU VAT legislation as part of the VITA package. And the aim of these comprehensive proposals is simply just to modernize the European VAT system by promoting harmonized invoicing and digital reporting requirements, by helping to reduce fraud and VAT loss through non-reporting of VAT, as well as by reducing compliance costs for businesses which currently have to comply with fragmented reported requirements across the European Union. And these proposals imply that the legislation will take effect in phases from give or take 2025 until give or take 2028, and cover 3 main areas of VAT policy. So namely digital reporting requirements, including invoicing, the VAT treatment of the platform economy, and last but not least, the single place of VAT registration and one-stop shop regimes. We need, of course, to bear in mind that these are just proposals, and that before being brought to law, a few steps will need to be taken, including the adoption of this by the Council of the European Union, which of course imply the signing off by each and every single European member state, and a few other steps that we'll be mentioning later on. And these are effectively a series of measures put in place to modernize and to make the EU's VAT system work better for businesses, and also to make it more resilient to fraud, and to do so by embracing and promoting digitalization. And the proposals also aim to address challenges in the area of VAT raised by the development of the platform economy, which of course has been developing much quicker than VAT legislation. If you're bearing in mind that this VAT legislation was in a great part drafted a few decades ago. And just to provide you with some context, European member states lost 93 billion in VAT revenues in 2020, according to the 2022 VAT gap report, which has just been published. Now, this figure is down from 134 billion in 2019, but it is believed that a great portion of that decrease is actually due to the fact that there was less commerce between European member states in 2020 as a result of COVID. And conservative figures suggest that 1/4 of the missing revenues can actually be attributed directly to VAT fraud linked to intra-EU trade. And this is why these packages are so important, and why it is extremely likely, in our opinion, that EU member states will be backing this. Although of course, I mean, there might be some amendments relating to part of the details of the changes, and maybe some improvements as well. And in addition, and another very good reason as to why these proposals are likely to be implemented is that the VAT arrangements in the European Union can still be burdensome for businesses, especially for small and medium enterprises, especially for scale-ups and other companies who operate cross-border. It is very, very difficult for businesses to address the requirements in a single scalable way, and the complexity of the current system can lead to additional admin costs and lack of compliance. But as always, bringing in change to simplify matters can create additional complexities, and these complexities can be best tackled when engaging with robust and cohesive international networks like ours, networks that rely on strong and up-to-date technical knowledge. That is, of course, key to ensure that taxpayers can plan ahead of changes and can do so in confidence and in a way that minimizes administration and maximizes opportunities. And of course, we have achieved this working very closely with experienced practitioners such as Stephen Dell, who is an authority in the world of VAT. He lectures at 3 French universities on indirect taxation. And Stephen is also the president of the International VAT Association. He is a member of the EU Commission's VAT expert group and a member of the OECD's Technical Advisory Group on consumption taxes. And we'll also involve Giacomo Lucchetta, who is a senior policy expert with more than 10 years experience in EU policy studies. Giacomo was the team leader for the study on VAT in the digital age, supporting the European Union Commission through its impact assessment process. So he had a very, very key role in all of this. And since the VAT in the digital age reporting reforms are the most substantial modernization of VAT in Europe since the establishment of the single market 30 years ago, obviously, should this be implemented, that jolly good publication named the VAT in the EU, which is now in its 4th edition and that has recently been published by Tolly's LexisNexis, will need to be updated quite substantially. So probably now this is a good time to pass the mic to Giacomo will be illustrating all of the changes that we will need to put through within this publication when it comes to digital reporting requirements, including invoicing. Prego, Giacomo.
Grazie Luigi, thanks to PKF for the invitation. It's a pleasure for me being here in front of such a renowned audience to share a little bit of the journey we made supporting the European Commission in the impact assessment process that preceded the definition and publication of the legislative proposal. I'm taking care especially of digital reporting requirements and the invoicing. These are possibly the most fundamental change because it will touch upon every single taxable person in the EU in one way or another. I mean, it's not sectoral, it's not only for cross-border operators, it's for everybody. And the change to the rules are actually pretty simple. I mean, I don't want to say simple, it's surely simpler than the other parts. So let me spend a couple of slides on the problems that was there and how the Commission decided to act. So the Commission was confronted with two facts. First of all, what are digital reporting requirements and the invoicing? I mean, the Commission defined digital reporting requirements as any tool through which taxable person provide transactional information on to the tax authorities, meaning transaction by transaction. It includes like things like VAT listing in the Czech Republic, SAFT in Poland and in Portugal, real-time system in Spain and Hungary, and the invoicing, because invoicing it's something different in a way, but it has the same objective, giving tax authorities information on specific transactions. At the moment, there are about 14 of these systems in the EU, more are soon to come. France, some have been announced pretty quickly, Belgium and Germany, some are changing, such as Poland. All these national systems are different. And this is a typical problem for the European Commission, is a failure of the single market because companies operating in different jurisdictions, multinational companies, face an unnecessary cost because of the application of these digital reporting requirements. We calculated that the cost at EU level is like some 1.6 billion euros, not peanuts. And for a large multinational, it can cost between few hundreds and 1 million euros to comply with this system, especially in countries such as Italy, Spain, and Hungary, which have a more advanced system compared to other European member states. To be also fair, it is a problem only for multinationals because my plumber in Italy, he needs to make me an electronic invoice if he works for my company, but is not really concerned about what's going on in Poland or Germany or France. So it's a problem for multinational operators. The second fact, and this we substantiate in the study in some detail, is that countries that have introduced digital reporting requirement or invoicing have seen a significant increase of VAT revenue. In other terms, lower tax evasion. The effect is positive and significant. I'm using significant in econometric terms across the group of countries that we have studied. So basically, we compare what happened in countries which have those report requirements and countries that have not. And in countries with digital reporting requirements, their introduction resulted in an increase in VAT revenue by 3 to 4%. Again, not peanuts, not at all. This goes, even though, and we also provide some data on these requirements are costly for companies, sometimes very costly, because you have to set up new procedures, invest in IT system, train your personnel, these kind of things. But all in all, the reduction of tax evasion more than compensate for the cost of companies. The problem is that costs fall on companies and benefits go to the public revenue, to the public budget. The situation is compounded by the structure of the VAT directive, which in its current form limits the adoption of invoicing by requiring customers' acceptance, and also by not allowing member states to impose mandatory invoicing unless they ask for a derogation from the VAT directive. Italy got a derogation, France and Poland got a derogation, but it's kind of a cumbersome process. Finally, the other part of the problem is that the current tool to track intra-EU transactions This is called recapitulative statements or EC sale listing in other countries, is outdated and ineffective. And now that we have seen the problems to tackle, let's see the possible policy option to address these problems. The Commission screened a number of possible policy choices, including doing nothing that is required. I mean, any new intervention needs to be at least better than doing nothing. This intervention went from more deep to less deep, to broader to narrower interventions, and eventually the Commission decided for an approach that is a bit intermediate, approach number 4 in the slide, to require reporting of intra-EU transactions, so to introduce digital reporting requirement for intra-EU transaction only. So it felt sure than requiring this kind of tool for every single transaction, including domestically. The new rules have some significant implication both on invoicing and intra-EU reporting requirements that we will now see in some detail. For invoicing, if I have to summarize one thing I have to explain to my friend at a cafe, is that structured electronic invoicing becomes the standard form of invoicing in the EU from 2028. And here the stress is not only on electronic invoicing, but on structure, meaning machine-readable electronic invoicing. PDF will not be a structured electronic invoice. From 2028, the default is that all invoices should be structured and electronic. This could be based on the existing harmonized standard for invoices, but national standards can coexist, provided the taxable person can have the possibility to use the European standard. They can then choose whether using the national European standard. That's very important for the existing regimes, obviously. And in this way, the definition of electronic invoice in the VAT directive is aligned with what exists in the area of B2G invoicing, where structured electronic invoices are already required. At least their acceptance is required, but they are the de facto standard in most member states. And here I can only commend the fact that the technological gap of the VAT directive has been filled, because only structured invoicing allow for the automation of business processes and risk analysis. Member states, as I said, can still allow paper or a structured invoices for domestic transactions, but not for intra-EU transactions. And the idea, if I can read beyond the line, is that with time, all member states will converge to the same mandatory structured invoicing for all transactions. And this is possibly the compromise of the Commission. They could not impose it at the moment, but they created a framework which is conducive to a situation in which structured electronic invoicing becomes the rule. This is done also by removing the current constraints. So the customer's acceptance is removed. The need to go for a derogation by member states wishing to impose mandatory invoicing is removed. There's maybe a couple of issues I want to mention, which I find a little bit, I mean, not I wouldn't say critical, but surely less positive. This comes with a very shortening of the period for issuing an invoice. When a structured electronic invoice is required for intra-EU transactions, it should be issued in 2 days, which is, I know, very difficult for corporations. And also with paper invoices, you could, or PDF invoices, you could fake on the date, but not with structured electronic invoices. Meaning that, and also in Italy, when electronic invoices was introduced, this led to a relaxation of the issuance time from 1 to 12 days, because I mean, it may be on a Saturday morning, the system may be down for a date, it can happen. And you need a little bit of elasticity to issue the structured electronic invoices. And the second is possibly following the French approach to electronic invoices. All invoices should also include data on payment details and due date. I suppose that the idea there is to fight late payments, but I'm afraid that there's no evidence whatsoever that electronic invoices is positively correlated with with payment delays and mentioning the date on the electronic invoice, I mean, can help having a signaling effect, but it's a considerable additional burden for companies to monitor payment on the invoice or via the invoicing system. That's something that that could be discussed to some extent. The only thing is that we acknowledge in the study, and also the impact assessment acknowledges it, that there is a cost for businesses, even though they get some simplifications such as pre-filled VAT returns, removal of other obligations. But there is a cost for businesses and a benefit for public budgets, and there is a trade-off in terms of cost and benefits in the proposal. Let's now see the changes introduced for reporting requirements. Here, again, over the next years, what will happen is that all intra-EU transactions will have to be reported on a real-time and transaction basis. So very close to the chargeability date, so very close to the event, and on a transaction by transaction basis. The new system will cover intra-EU supplies and intra-EU acquisition of goods, but also intra-EU supplies of services under reverse charge by both the supplier and the customer. So let me be inaccurate in a way, but all intra-EU supplies will be covered. And the member states can also introduce it for domestic transactions or for other transactions, but this remains optional. The caveat is, if member states want to introduce the system also for domestic transactions, they should use the same system as it for the European level. What is this system? It is yet unclear. Also, the proposal makes reference to an implementing regulation which will detail the modality of data transmission, the data requirement, the format, the syntax, all the technical details, which are very important in this case. But the directive makes it clear that member states should allow the following situation. Me as a taxable person, I issue an invoice, I share it with the member state takes the data there for their reporting obligation. And in a way, it's two things with one action. You both issue an invoice and you both comply with your reporting duties via the same tool. And it is something which, again, I commend. And again, the directive says very explicitly that compliance can be done by means of the European invoicing standard or other national formats for invoicing, meaning that in the future, multinational companies will be able to use the same standard across all member states with a simplification for them. If you're a domestic taxable person, meaning taxable person only operating domestically, you can choose whether using the European standard, the national standard, maybe simpler, or just you're more used to it because it's already enforced for B2G, it's already enforced for B2B. So the idea is that the European system will become available in parallel to other national systems. So convergence is ensured in the medium term without having to replace existing systems, which obviously was a significant worry for the Commission to avoid duplication of cost. With that said, I close my presentation of invoicing, and I now pass the ball to Stephen for the other two parts of the initiatives.
Thank you, Giacomo. Yeah, I entirely agree with the comments that we've made or have been made so far. I mean, this is a very, very important set of changes if, of course, as Luigi brilliantly pointed out, they are all adopted as currently drafted by the member states unanimously in the Council. The second part and the third part of the programme or the package put forward by the Commission are in many ways going to impact businesses in a slightly different way, perhaps less important, less fundamentally than the first part of the package. But we will see nonetheless going through, in particular the third part around the single place of VAT declaration, that many businesses are going to be concerned, impacted by the changes being put forward by the Commission, in some cases in a very substantial way. On the platform economy, I haven't set out in here the various different options or policy options that the study group was asked to consider by the Commission, because they were very wide-ranging. And one of the options that the study group was asked to consider, asked to evaluate, was an option whereby the whole of the platform economy would be brought into effectively a new VAT regime, where it would be the platform facilitating an underlying transaction that would be liable to account for the VAT due on the underlying supplies. The Commission didn't go that way, didn't go down that route in imposing or proposing rather that all platforms should be brought within the scope of the deemed supply provisions. And effectively, we've only got two. That is in platforms facilitating passenger transport and those facilitating short-term accommodation. There is one further modification that's being proposed by the Commission, and that's in relation to those platforms facilitating supplies of goods being sold on a distance sale basis, where the platform facilitating those supplies is deemed itself to have acquired and supplied the goods. That rule today only applies in the case where the underlying supplier is himself not established within the EU. The Commission proposes that that rule is extended such that all businesses, whether EU or non-EU established, supplying goods through a platform which is facilitating the supply of the goods, it's the platform itself then becomes the one liable to account for the VAT on the total transaction value. So the idea behind this is to essentially ensure there's a uniform application of VAT rules across all member states. There is a level playing field in place between online and what the Commission calls the traditional short-term accommodation and transport services. What essentially that means is that in relation to short-term accommodation, and we have in the proposal a changed definition, or rather a new definition of short-term accommodation, excluding accommodation from the scope of the exemption provisions in Article 135, such that any supply within the definition of short-term accommodation will become subject to VAT in the member state, of course, in which the accommodation is situated. It will also ensure, by making the platforms liable to account for the VAT on the supplies, simplify the life for SMEs, enable them to operate more freely, more easily across borders, and they would then not have the need to understand and comply with the VAT rules, often in other member states. So the idea, quite simply, is to introduce a deemed supplier regime in relation to short-term accommodation and passenger transport. And this is being done by the introduction of a new Article 28A into the VAT directive, and essentially says that where the underlying supplier does not charge VAT because they're, for example, a natural person, or they make use of one of the special schemes for small enterprises, so a registration threshold, for example, then it is the platform that charges and accounts for the VAT on the underlying supply. That is the supply being made by in the case of accommodation, the accommodation provider. And just to be absolutely clear, we'll have a new article in Article 306, which will make it certain that any transaction falling within the scope of Article 28A, the deemed supplier provisions, will fall outside of the scope of the tour operators margin scheme, the TOMS. Where the platform facilitates. So again, we've got this notion of facilitating. We've seen this before in relation to electronically supplied services. We've seen this also in relation to imported goods from third countries, third territories, where a platform facilitates the supply of the goods of a value not exceeding 150 euros into the EU. We've seen this notion of facilitation before. And the notion that's been retained in relation to short-term accommodation and passenger transport is essentially the same. It only will apply, the deemed supplier provisions only apply where the underlying supplier does not charge VAT. So he'll be required, or he will have to be asked by the platform as to whether he has a VAT number, the underlying supplier. If the underlying supplier does not have one, or even if he does have one, it is not the one that is used in relation to the supplies of the short-term accommodation or the passenger transport, then in that case, it is the platform which is liable to account for the VAT on the total supply and not the underlying supplier. The idea is by doing this, it will remove any potential distortion of competition between accommodation providers, short-term accommodation providers, and the traditional economy. And this, by this, the Commission means the hotel sector. The fee charged by the platform to the underlying supplier, so the facilitation fee, intermediary fee, is now to be made absolutely clear as to how this should be treated. And it will, in all cases, in relation to the underlying transactions which are facilitated and therefore deemed to be supplied by the platform, these intermediary fees will be subject to taxation in the member state in which the underlying transaction takes place. So no longer will we have the possibility to consider the intermediary fee is an electronically supplied service, whereby the VAT will be due where the customer is located, B2C basis, rather than where, as what is now being proposed, where the underlying transaction takes place, which of course could be very different. The VAT on the supply being made by the platform as deemed supplier can also possibly be accounted for via the one-stop shop if the platform so desire. And of course, remembering that the one-stop shop regime is optional, it's not compulsory, and platforms could, of course, if they so wished, register for VAT in each member state in which the supplies are deemed to have been made. As I mentioned, rental of accommodation, we've got a changed definition with the addition of a new Article 135.3 in the directive, which takes out of the scope of the exemption in Article 135 short-term accommodation as defined, which is no more than 45 days. And this will be the case even if no ancillary services are provided, which a hotel might be expected to provide. So this would mean, for example, a very significant change here in France, where currently we only consider that the exemption does not apply where, in addition to the accommodation itself being provided, there are other ancillary services of a type, nature, which a hotel might be expected to provide. As for the other deemed supplier provisions, the supply by the underlying supplier to the platform itself is VAT exempt, just as we have currently under Article 136A. Just to clarify a point, it was a subject of quite some number of discussions with the Commission that even if the supply by the platform in its role as facilitating a supply which itself is exempt, there were concerns expressed that this would then have an impact on the right of deduction of the platform of its own input VAT. And the Commission proposes that by addition of new Article 172A, that even where the underlying supply is exempt, this will not of itself have any impact on the deduction rights of the platform. There are extended record-keeping obligations for platforms in Article 242, and Article 242A is amended even further. And just a reminder that Article 242A also applies in the situation where the platform is not itself liable for the tax on the supply, whether goods or services, but where the place of the supply that the platform is involved in is within itself within the EU, then the platform has a reporting obligation. Not that the platform has to provide the data to the tax authorities. The tax authorities have to, if they want the data, they have to go to the platform and get the data. Today, if they want that data, then they have to, or member states rather can, request that data in whatever format they so wish. The proposal of the Commission is to ensure that the data that platforms have to provide will be in a standardized format. I mentioned about the notion of facilitation. We've got amendments to the implementing regulation to make quite clear in what circumstances, in which situations the facilitation rule is deemed to have been respected. I've mentioned that they will need to get or to check, or the platform need to check whether the underlying supply has a VAT number or not, and what the VAT number is to be used for, and so on and so forth. The platform will only be liable to account for the VAT as a deemed supplier in a transaction which is a B2C transaction. The customer at the end of the chain is himself a non-taxable person. And the rule that will apply will be that the platform will consider that the final customer is a non-taxable person unless he has specific information to the contrary. So as a non-taxable person. So just a quick reminder how this is all going to work, or being proposed rather. So Little House, if you like, is the underlying supplier. He's supplying accommodation, falls within Article 28A. The supply has been made through a facilitating platform, and the service is being provided to a consumer, a B2C. Then the VAT, if the supply of the accommodation falls within the new Article 135.3, so a short-term accommodation subject to VAT, then the platform will collect the VAT that's due on that supply at the VAT rate, of course, of the member state in which the accommodation is located. And that VAT that the platform will collect from the final customer will be remitted by the platform to the tax authority of the member state in which the accommodation is provided, unless, as I mentioned earlier, the platform elects to apply the one-stop shop. Intermediary fee, I discussed very briefly, and just a reminder again that the place of that supply of the intermediary fee rather is where the underlying supply takes place, and it will not be considered to be an electronic supplied service in ESS. And the third pillar, we've got major changes impacting both B2C transactions and B2B transactions as well. So for the first time, really, we're now extending the one-stop shop mechanism, or the Commission's proposal rather to extend the one-stop shop mechanisms to certain B2B transactions, as well as those within the B2C sphere. Building essentially on what's already been done, and the Commission, in addition, is proposing to make certain changes to the import one-stop shop mechanism by essentially making that mechanism mandatory for the platforms facilitating sales to consumers in the EU. For a very simple reason, the Commission's have indicated that from the studies that have been undertaken, it's over 90% of all low-value goods, so those of value not exceeding €150 in value, that are being brought into the EU are being brought in through platforms facilitating transactions, or using the one-stop shop, import one-stop shop, and therefore the Commission said, well, let's just make it compulsory for everybody acting as a facilitating platform. It just makes life easier for administrations, customs authorities to collect the tax that is due. So as I mentioned, we've now got 4 one-stop special schemes. First one is in relation to transfers, which I'll come on to a second. But before I got on to transfers, a quick change also that's been made, but an important one again, whereby the Commission is proposing to avoid, the objective, remember, is to have a single place of VAT registration where a business can declare all of its transactions through one member state rather than through multiple member states, having to go through registration process procedures in each member state in which the underlying transactions take place. The idea here is by extending Article 194, which currently only 15 member states apply, and then not all in the same manner, is to make the non-established supplier supplying goods or services in a member state in which it's not established, to bring all those transactions within the scope of Article 194. What Article 194 basically says is that any VAT that's due on those supplies in the member state in which the supply is not established, the VAT due on those supplies will be accounted for by the VAT registered, whether established or not, business receiving those goods or services under a reverse charge mechanism. There will, however, be recapitulated statements required in order to be able to track these transactions occurring in a different member state to that in which the business making the supplies is established. So there will be reporting obligations, linking very much back to the first part of the package, which Giacomo brilliantly outlined for us earlier. There will not be any input VAT offset. This was one of the options which the study group looked at, which was to say, well, if you've got a business making supplies in a member state where the reverse charge will apply, so the VAT is accounted for by the recipient of the transaction, should there not also be an offset mechanism or a way of claiming back any input VAT which the non-established supplier has incurred in that second member state without going through the VAT refund directives? That proposition was not retained, policy option was not retained, and that is unfortunately where we are today. Invoice had to be issued within 50 days of supply. That will be from 1st July 2025, and then from 2 days from 1st of January 2028. On the one-stop shop, as I mentioned, we've got modifications to the one-stop shop regimes as introduced in July 2021. Distance sales were extended now, to, or definition rather, extended to include second-hand goods, works of art, collector's items, and there will be a particular rule for works of art without dispatch or transport, in other words, where they all take place in the same member state, to also possibly be declared or potentially be declared for a one-stop shop. And I mentioned already, right, the deemed supplier regime for goods, which will now be extended to apply regardless of where the underlying supply is established, i.e. within or outside of the EU. The €10,000 threshold as to whether the VAT of the country of establishment applies or the country of delivery for the case of goods, country establishment in relation to services, that threshold will be limited going forwards to sales of goods only. Even though currently that 10,000 threshold applies to both distance sales of goods and ESS. On the import one-stop shop, I think on the one-stop shop itself, we've looked at most of the issues here. There was one tweak in the proposal being brought forward, and that is to allow the one-stop shop for non-EU established suppliers to be used also where the customer is himself not established in the EU, but where the use and enjoyment rule applies, where the tax is due in a member state nonetheless. That tax can now be accounted for equally through the one-stop shop. And the one-stop shop will also be extended to cover zero-rated and exempt supplies. On the import one-stop shop, I mentioned that will now become compulsory. That's a proposal for electronic interface facilitators. Discussions were held around whether the €150 ceiling should be increased. Those discussions are ongoing, essentially with the customs authorities. There's a customs issue rather than a VAT one. That €150 ceiling is retained. On the transfers, I mentioned that we've got a fourth one-stop shop, and this one applies to transfers of own goods within the EU. It was to do with this particular case where you have businesses transferring their own goods from one member state to another, and then selling those goods transferred into the second member state within that second member state. Happens a lot in the e-commerce field, but not only in the e-commerce field. If we look at a number of cases where businesses move goods around from one member state to another, where the goods don't come back to the member state of departure, then outside the e-commerce area, there are significant numbers of transactions in that area. Idea will be that these transfers, not taxed, will be declared through a transfer own goods one-stop shop. The arrival of the goods in the second member state will not be subject to VAT. They'll be treated as exempt. There'll be a special transfers VAT return. There'll be certain goods which are excluded, and all those transactions will be declared through the transfer one-stop shop on the transfer, and then the subsequent supply in member state 2 will be declared by the OSS when the VAT actually accounted for on the subsequent sale. Certain goods are excluded. Capital goods will not be included within the scope of the scheme. Neither will any goods which will not give right to a full right to deduction in the member state of arrival acquisition. And there are lots of detailed rules. We've now got down to Article 369XI, which will determine in the different circumstances what the reporting obligations are, who can be excluded from the scheme, obligation to file monthly returns and so forth. And again, like the other one-stop shops, there is no input tax deduction, and any input VAT incurred in the second member state, in my example, will have to be recovered through refund directive, either the 2008/9 or the 13th VAT directive, depending on where the company is located. Or if the company has a separate VAT return, the VAT can be recovered through the local return. Consequence, though, of this one-stop shop, transfer one-stop shop, is that the call-off-stock quick fix is withdrawn. It's withdrawn with effect from the end of 2024. There's a transitional year, 2025, and it effectively completely disappears in 1 January 2026, requiring amendments to be made to the relevant articles. So that's all I have to say on the single place of VAT registration. There's a lot, and very dense. We're conscious of this. We have quite a few questions coming in. So let me now hand back to Luigi for some questions and answers and conclusions.
Thank you, Stephen, and thank you, of course, to our very special guest, Giacomo Lucchetta, for this quick counter through of the significant VAT reforms that have been released by the EU Commission late last week. And these reforms comprise of enormous changes, big admin savings, and substantial spend on digitalization to reduce fraud and to make cross-border transactions a little easier. And of course, also to level up the playing field and raise more money on taxes. We might find, as a result of these reforms, a huge reduction of foreign VAT registrations that will enable sellers to enjoy the benefit of the single market, and will enable, of course, also tax authorities to deal with fewer sellers, which is, of course, a very welcome development for them. More traders will end up within the tax net, though, which is, of course, key in ensuring that a level playing field is put in place, and that all suppliers that have European VAT obligations, even if located outside of Europe, will be compliant. And it is, of course, also fair to say that it will be considerably harder for suppliers to dodge the VAT bill. And this should also ensure that the tax authorities will be in a much better position to ensure traders that are established outside of the European Union are compliant with their own EU VAT obligations. And when it comes to digital marketplaces for transport and accommodation sharing, the digital platforms will become the principal and will no longer be able to benefit from the unfair competition generated by the fact that many or even most sharers and many or even most taxi drivers are operating under the VAT registration threshold. There will also be a number of obligations that will no longer be required, such as, for example, the easy sales lists, which will no longer be due with effect from 2028, most likely. And of course, all relevant taxpayers and advisors should also consider how to manage from a practical level the various other changes that have been put in place recently, and which can be taken into consideration also to understand what can be done to remain compliant without adding excessive administration. And that is why we will be hosting a whole webinar on the 7th of February 2023, focusing on the global complexity of indirect taxes and e-commerce. We will be doing so by providing information about indirect tax compliance requirements globally and steps that can be taken to minimize indirect tax administration and exposure. And if the topic does not catch your fancy, I hope that this rather inspired title will. And I hope that you found this session helpful. And I guess that with only 10 minutes to go, now it is probably a good time to leave the mic to Stefan, who I understand has been collecting a fair amount of questions.
Yes, thank you, Luigi. Yes, indeed, we received a number of questions. And I think the first one is directed to you. You mentioned earlier on in the session about a few steps that need to be taken before it is brought to law. I guess you were referring to the consultation. What are the immediate next steps for VAT in the digital age?
First of all, we need to consider that VIDA needs unanimous approval by each and every single European member state. And it is therefore subject to change and to amendments, and there is going to be an open consultation, which is in practice a feedback period. And this open consultation will be for a minimum period of 8 weeks, and this clock will start ticking as soon as the legislation is published in each and every single language of the European Union. Now, this feedback will then be presented to the European Parliament and the European Council, with the aim that this will then feed into the legislative debate, which should then, at least in theory, finalize the matter. Some of the points that we have covered are likely to come in as early as in 24.5 months from now. And some of the most complex matters, such as intra-EU digital reporting, will be in place technically by 2028. Certainly, we will have 5 trillion years ahead of us, but the key to success to all taxpayers doing business in Europe, never mind where they're located, is to act early and start planning for the changes to come.
Okay, thank you, Luigi. A second question, I believe, is directed to Giacomo. Giacomo, a question for you on digital reporting. Are there considerations for US companies selling goods into the EU to think about, or will it continue to work as it currently does, assuming goods are sent from the US?
Many thanks for this question. At the moment, the proposal says that the reporting duties and hence the obligation to use structured electronic invoices only apply to taxable persons identified for VAT purposes in the EU. Meaning that if your company currently does not need to register for VAT in the EU because the place of supply rules do not require it, at the moment, they remain outside the EU invoicing and digital reporting system. Member states cannot, given the way the proposal is written, apply additional burdens to taxable persons which are not identified for VAT purposes in the EU.
Okay, thank you, Giacomo. A third question, I believe, is directed to you, Stephen. Would the implementation of the deemed supply regime not lead to a distortion between, for example, accommodation operators making a supply via the platform with a deemed exempt supply by the operator to the platform, thus not permitting the operator to input VAT recovery compared to the operator accounting for the VAT via its own VAT registration? Quite a complicated question.
Yes, thank you, Stefan. It's a very good question, actually. The issue, in fact, is very much around the application in the different member states of the court decision in the case of Fuchs. People may remember that this case involved the installation of solar panels on the house for private residence, and the question was when that person on-sold electricity back to, I think, the German electricity network. The question was, was that person acting as a taxable person? The reason why the supply or the deemed supply between the accommodation provider and the platform is treated being exempt is essentially to try and dissuade people from making, perhaps we say, exaggerated claims for input VAT in relation to the accommodation that's being provided. An example would be somebody lets out just one room in their house and they try and claim an input VAT deduction on having the whole house repainted. So member states, were very much in favour of making the supply from the property owner to the platform as being exempt. Also taking into account that many member states have relatively high registration thresholds for businesses providing accommodation, guest houses and so forth, which would be the case in relation to, for example, France. So I think those two things taken together indicate as to why that supply is being made exempt. It's just, as I say, to to dissuade, shall we say, or prevent by making the supply exempt. Property owners making exaggerated claims for input VAT, which of course then puts a huge burden on tax administrations and having to control and validate what may at the end of the day be individually be fairly small amounts of VAT being claimed back.
Okay, thank you, Stephen. Another question also for you, I think. Could this work for businesses that are not actually selling goods? For example, where a US pharma company moves goods into and out of EU member states for packaging and labeling?
I think that's a great question. It would probably take on a good day about 3 hours to respond to it, which I'm sure Stefan as timekeeper would say we don't have time to do. No, but seriously, it will of course depend how the goods are moved into the EU, how they're moved out again. I mean, there are various customs suspensive regimes, inward processing, for example, where the goods can be brought into the EU, processed within the EU, and then re-exported from the EU without any customs or VAT being accounted for or having to be charged when those goods are brought into the EU in the first instance. If, on the other hand, the goods are imported, the question then becomes who's the importer? Certain member states say it is only the owner of the goods that can import the goods, or at least to import the goods and get the VAT back on importation. And therefore, that would require a VAT registration on behalf of the US company. Once the company is VAT registered, then as Giacomo has just pointed out, potentially when goods then move across border, the digital reporting requirements would then kick in. And that US company might find itself having to file reporting, digital reporting, with the member states concerned, or the member state in which it is elected, to account for VAT or register rather.
Okay, thank you, Stephen. We still have a bit of time, and there's still 2 questions that we received. Actually, these are 2 questions relating to Ghana, which are in practice not about Ghana, but I think they could be handled by Giacomo with a short answer. So in Ghana, I'm wondering how the structured e-invoicing will be applicable when some taxpayers are opposing the e-invoicing regime, and how will the online registration be done in Ghana when the taxpayer portal is owned by the Ghana Revenue Authority? Giacomo.
Yes, well, I think I read somewhere that the Ghana is also considering invoicing, but I'm not an expert on the Ghana infrastructure, to be honest. But let me say something, 2 comments on these questions. First of all, it won't apply unless the Ghanaian company is identified for VAT purposes in the EU, as I just said. And then the question about the ownership of the taxpayer portal or the clearance system, the invoicing platform, is a topic that we have discussed extensively during the project. And let's say that many member states don't have an incentive to operate or to require the use of a public platform, different to what is in Italy, where the taxpayer portal is owned and operated by the Italian tax authority. What we said in the study is that that's something that it's for member states to decide. As long as the system is compatible across the EU, there was no reason to recommend one solution or the other as superior from the perspective of the taxpayers.
Okay, thank you, Giacomo. So this concludes our Q&A session for today's webinar. Thank you for the questions sent through. Before we end today's session, we would like to draw your attention to some of the free tax resources which we have available. You can access these by visiting our PKF International website at www.pkf.com. On our website, you will be able to locate the closest PKF firm within your city for assistance with any indirect tax challenges you might be facing. For your convenience, you can search by country, city, keywords, or use our world map to search by region. On behalf of today's panel, I would first like to thank all of you for joining us today globally. I would also like to thank all of the presenters for their hard work. The 3rd session of our Global Indirect Taxes series, My Best Friend's a Robot, will be hosted on the 7th of February 2023. You can register for this event through our website www.pkf.com or email events@pkf.com for the registration information. Also keep an eye on PKF International social media pages like LinkedIn, Facebook, and Twitter for the registration information of these upcoming events. In the meantime, be well and stay safe, and we hope to see you in our next PKF virtual event. Happy holidays.